Welcome to Microcap Explosions and Classic Value Investors. This is Mariusz Konieczny. I'm talking about portfolio turnover, quality of business today, and just how to better approach investing in these crazy days today. Now, when I look at some of the people and some of the activity by some of the investors that I actually respect and other investors that I don't necessarily respect, it is mind-boggling how much activity, portfolio turnover, and just constant need for trading is out there. And this kind of, this video was kind of actually sparked by someone who put a comment on Oracle's message board on Stockhouse saying something like, I don't know how some people here have been involved with Oracle for years, and I've only been involved for less than 12 months, and I'm already losing patience. And this is just kind of like the environment that we live in, is that nobody can hold, or the majority of people have a hard time holding on to positions for more than a few weeks or few months. It's very rare for someone to hold on to positions for years. And the cost of transacting brokerage fees have come down a lot over the last couple decades or whatever. And you have platforms such as Robinhood that apparently don't even charge you for commissions. So it's very easy to jump in and out from one idea to another. And you know, real wealth is built by finding good investment opportunities and sitting on them until they work out, or just continuing to ride them if it's in case of great businesses. It is not trading. And I know that it's difficult, especially when so many people are commenting on stocks, and it seems like everything that you don't own seems to be going up every day, and everything that you own seems to be stock. But this need for activity is not just it's not just in investing. If you feel like you need to be active all the time, it's probably better if you just start a business or something so you can do something every day. But when it comes to investing, activity, hyperactivity is just not your friend. And if you look at other things like, let's say, exercise to get fit, and you have all of these people that are providing exercise routines or exercise advice on YouTube or on the internet. And if you look at some of the advice that's out there, it's these people have to constantly give their viewers new routines, new things to do, because people get bored. No, I mean, really what they should be doing is eat right, exercise consistently, and just do it over and over and over, and you will get results. But who wants to watch videos like this? So they have to constantly give people new stuff to do, so that they don't lose viewership. Um, like, you guys know that I'm a dancer, and I constantly see it in dancing, where couples constantly have to change their routines or choreography. They just can't stick with one. And the most successful dancers, they have the same routines and the same choreography for years and years. And that's what makes it successful, because they can perfect what they have. If you look at like a quote from Bruce Lee that said that, I don't fear a man that has done 10,000 moves one time, but I fear a man who has done one move 10,000 times. I mean, it totally makes a lot of sense, but with the world we live in, it's just we forget that. So I want to kind of go over some of the choices that you have when it comes to investing. What you have in front of you is a quality of a business and a price of a business. Okay, because as we said before, stocks represent ownership interest in a business. So you have a choice when you're buying businesses. You can buy a good business or you can buy a bad business. Okay? And when you buy a good business, you can buy it at a wonderful price, a high price, in other words, or reasonable price, or a cheap price. It's very difficult to buy good businesses at a cheap price, but it's not uncommon to buy good businesses at a reasonable price. And then when it comes to bad businesses, you can also buy them at a wonderful price. You can buy those bad businesses at a reasonable price, or you can buy them at a cheap price. So let me just give you some examples, for example, of wonderful businesses. Here you have a wonderful business that I wrote about it in How to Profit from the Coronavirus Recession. It's Copart, and what Copart is like an eBay of salvage cars. It's a I'm just going to read it what I wrote. Copart is a fantastic business with a moat from high barriers of entry and a network effect. The company hosts online salvage car auctions. In other words, it takes junked cars and auctions them for insurance, auto dealer, and car rental companies. Buyers are rebuilders, licensed dismantlers, and used dealers and exporters. Now, if you look at some of the metrics of Copart, this is from Morningstar, and you look at like return on assets and return on equity. Look at these wonderful numbers. Okay, return on assets, almost 16%, 21, 20, 24, 23, and then return on equity, it's even higher, 22, 31, 42, 31, 35, 33. I mean, this is just a wonderful business. Now, the problem is that you really, it's very unusual to buy a business like this at a cheap price. The only time you were able to buy it at a cheap price was when I wrote this book, which was in March during the sell-off. But it's not necessary to buy such wonderful businesses at cheap prices. If you look at the maximum stock price over the last 20 years, I mean, look at this. It in 2000 it was trading at like $3, and now it's trading at 120. Okay, that's like a 40x. So now almost at any price that you paid for it, if you held it long enough, you would have made so much money. So a business like this, it's a wonderful business. Most of the time, you can you can only get it at a reasonable price. Sometimes you can get it at a cheap price, and as long as you don't pay a ridiculous price for a business like this, meaning if you don't pay a wonderful price, if you hold it long enough and then they continue generating such wonderful returns, you're going to make a lot of money. And all you have to do is buy it and sit on your ass and do nothing. Let's look at another business. Moody's Corporation. I'm sure a lot of you have heard about it, especially when if you were around during the 2008-2009 financial crisis, when Moody's was in a lot of trouble. Moody's is a company that does credit. It's a credit rating agency. There's only really like two players, so it's almost like, I mean, it is like a duopoly. Wonderful business. And I wrote about Moody's in 2009 in the Why Are We So Clueless About the Stock Market. And if you look at, let's look at some metrics first. I mean, look at these returns on equity, almost 2000%, 265. I mean, this is a fantastic business. Is anybody talking about this business? No. Why? Because it's not exotic. It's not disruptive. It doesn't have to be disruptive. A wonderful business will create wonderful returns for you if you don't overpay for it. And so this is return on equity. Look at like some of the gross margins. 70%. I mean, anytime you have a business that have margins like this, and returning customers, and it barely has any competition. I mean, you literally cannot go wrong with a business like this. Now let's look at the stock price. Look at it. Look at it. From 2000, the stock went from like $10 to almost $300. That's a 30 bagger. And then look at it from 2008. This is when I wrote about it in the book, right? From that sell-off, it was about $20, and now since then, 10 bagger from there. And again, I didn't see anybody writing about this. I didn't see anybody talking about it. And Moody's is another example of a good, I should have said maybe wonderful, wonderful business that only in certain instances it can trade at a cheap price, like 2008, 2009, but most of the time it trades as a reasonable price, and it's absolutely okay to buy something like this as a reasonable price. I see a lot of talk right now, people talking about how value investing, is out of vogue, or it's dead. And I think people have a big misconception of what value investing is. They think that in order to be a value investor, you have to buy for less than something is worth. Absolutely not. Now, yes, if you have a business and it's trading for 50 cents on a dollar, yes, that's one of the definition of value investing. But there's nothing wrong with buying dollar bills, even for $1.20 or $1.30, as long as the dollar increases, as long as the value increases over time with businesses that I just described to you. Let's look at some examples of maybe some bad businesses, or maybe not bad businesses, but not wonderful businesses. One example is a car manufacturing business. So let's look at Toyota. Okay, let's look at Toyota, and if we look at the stock chart over the last 20 years or whatever, now it looks completely different from the other ones. Yes, you could have made money if you traded it correctly, but let's say you bought it somewhere around 2000, let's say for $70. Yes, you made some money, you doubled your money over 20 years. Okay, now let's look at some performance metrics. Now if you look at returns on equity for a company like this, it's this is actually pretty good for a car manufacturing company, but it's not even comparable to something like Moody's that we just looked at. Look at the return on assets, how low this is, because this is a very capital intensive industry. They have to have debt, they have to lever up. And look at the gross margins. Remember, Moody's was like 70, and here the gross margins are 17, 18, 18%. And like I said, this is actually pretty good for a car manufacturing company. Let's look at another company. This is Scorpio Tankers. I mean, a lot of you guys are invested in tankers, and when you look at it from the point of view of a business, whether it's a good or average or bad business, and if you look at return on assets, look how low the returns are, and they're even negative. Okay, return on equity very low. Gross margins are all over the place because the business is it's not stable, right? The rates for what they can get for moving the product, it varies. So then when you look at the stock price, I mean the performance from like even 2011, it was like 130, and it's down 90%. So now what we had examples of a bad business, you have like auto manufacturing companies. They're bad businesses. Then you have a choice. You can buy them at wonderful, reasonable, or cheap prices. Or another bad business is the tankers. So now the reason why we like them or people buy them is because they're trading very cheap, but they are bad businesses in comparison to some of the wonderful businesses that are out there. Now the best thing as an investor, the best combination that you can have is a wonderful or a good quality business that's trading at a cheap price, right? And so, and and the worst combination that you can have is a buy a bad business at a wonderful price. And now, can you guess what a bad business right now trading at a wonderful price is? Yes, it's Tesla. It's a shitty business because any business that's in the auto manufacturing industry, yes, I know it's a technology company and an energy company, but at the end of the day, it's a really bad business, okay? And it will always be a bad business because it's in a bad industry with a lot of competition, and a lot of competition means low returns and low margins. So it's a bad business trading at a wonderful price. Now, that's the worst possible combination, and everybody wants to get into it because they want to become millionaires. So now, but when we step back and look at it, is it a good business? No, it's a bad business. Is it trading at a cheap price? No. Is it trading at a reasonable price? No. Is it trading at a wonderful price? Yes. So for me, why would I even waste my time on a company like this when I can find, um, you know, good businesses trading either for reasonable prices or cheap prices? And right now, when it comes to what I have at Microcap Explosions, and that someone just asked me today if I'm going to buy back the tankers, and I don't think I will because at this point what I'm looking at is I have a lot of choices for wonderful businesses that are trading at cheap prices. Now, if those businesses were trading on the big exchanges, they would be trading at reasonable or wonderful prices. But because they are trading, they are wonderful quality businesses. But because they are trading at less known exchanges, I'm also getting them at a cheap price. And some of them within the next 12 months, they will be moving to a better exchange like Nasdaq, and they will continue being wonderful, but then I suspect that they are going to be re-rated and they will be trading at reasonable or wonderful prices. But my goal for investing is always to if I have a choice, it's to buy wonderful businesses that are either trading at reasonable or cheap prices and hold them for a very long time, because as long as they continue being wonderful businesses, they're going to continue generating returns that are satisfactory to me and other investors. So yeah, so I just wanted to give you an example of what kind of choices you have. And if you really want to build, sustaining real wealth, you ought to think about what it is that you're buying and just what kind of prices that you're paying. You don't always have to, buy them really cheap, but think about what it is that you're buying and what it is that you're paying for them. And once you find those wonderful businesses that are, keep delivering, just hold on to them. You don't have to find new idea every month. If you can find 3, 4, 5 really great businesses, they can those businesses alone can make you meet your financial goals.